This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Real Money helps you think through ideas for investing and trading stocks. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
Finding growth. The economy expands, but some say it's not fast enough. What it all means for you.
Big Mac's view, how McDonald sees the broader economy. We'll hear from the company's CEO.
And call it social investing. Why using social media to get a competitive edge in the market could be dangerous to your wealth. All this and more on Nightly Business Report for a Friday. Good evening, everyone. Susie, I guess any growth in the economy is better than no growth, and therefore is good news.
That's for sure. It was good, but not great. The U.S. economy grew by 2.5% in the first 3 months of this year, but that was less than the robust 3% most experts were predicting. Much of the gains in the gross domestic product came from strong consumer spending, but businesses and the government spent less, raising concerns that growth may grind to a halt in the months ahead unless some big changes are made. American consumers get most of the credit for revving up the economy. They were buying cars, lots of them, and houses, and paying utilities to heat those homes. Consumer spending rose at a 3.2% pace, the fastest in 2 years. So why was that GDP number such a bummer? Consumers funded many of their purchases by saving less. That trade-off pulled the nation's savings rate down to 2.6%, the lowest since 2007. Higher payroll taxes in March also didn't help. Paychecks got skimpier because of that 2% tax hike. Government spending cuts, the so-called sequester that went into effect on March 1st, were another biggie. Deep cuts in defense purchases were a big drag on economic growth, and so were the furloughs and layoffs. With new job worries back into the mix for hundreds of thousands of government employees, people turned cautious about spending. American businesses also pulled back, spending less on equipment and software and holding off from hiring. On the trade front, U.S. exports rose, but we imported more, and that sliced off growth. And American companies can't look to Europe for customers, as the recession there continues with little hope of improving anytime soon. There are now new concerns about the U.S. economy creeping along for the rest of this year, and more sequester cuts are on their way. Many government agencies are just beginning to furlough employees and cut back on spending.
Here now to discuss his economic outlook is Brian Westbury. He's chief economist of First Trust Advisors. Brian, welcome. Good to have you with us. Okay, so
Tyler,
great to have you. 2.5% in the first quarter. What do you see for the rest of the year? Are we going to kind of muddle along at this rate, or maybe a little better, maybe a little worse?
Yeah, well, Tyler, for the last couple of years, we've been describing the economy as the plow horse economy, not a race horse, not a thoroughbred. It ain't going to win the Kentucky Derby, but it isn't going to fall over and die either. And what we've been seeing is about 2% growth in this recovery. We actually expect this year, 2013, to accelerate a little bit from last year. We're looking for growth in the 2.5% to 3% range. So today's growth was on the lower side of that, or the growth in the first quarter. Housing's now coming back. Autos have fully recovered from the crisis. Banks are lending again. Consumer spending is at a record high. Business investment is up. And so, in fact, the private economy is growing even though the government is shrinking. And by the way, I think that's a good mix.
Brian, I noticed today that the bond yields on the 10-year were down about 1.6, 1.65. That would, all other things being equal, suggest a slowing economy.
Yeah, sure. Well, if you listen to bonds, we should have never had a recovery. If you look at stocks, you know that we've actually been growing, and corporate profits are at an all-time record high. You know, I think you can spin this data and make yourself feel really bad and talk about how government is a drag on growth. But in fact, if you take our GDP report today and take away the government spending declined. If you back away and just look at private sector growth, it was up 4% in the first quarter at an annualized rate. That's a boom. That's the kind of growth that we had in the 80s and 90s. Housing was up at double-digit pace. Consumer spending, as Susie said in her report, did very well. Business investment was up. When you look at those kinds of things, those are the real drivers of private sector growth. And I think we've scared ourselves into looking at every number from the glass half empty point of view. And I would rather see us think about it as the glass half full. In fact, in the past 4 years, when the economy has grown just 2%, plow horse type growth, the stock market is up 150%. So investors who would have believed in America would have more than doubled their money. And I think being fearful of the economy and what's going to happen in the future is costing people a lot these days.
2.5% growth with very little inflation is not necessarily a bad formula at all. You make the point, don't you, that the sequester actually may turn out to be, number one, less damaging to the economy than the hand-wringers would suggest, but also in a funny way, a good thing. Explain that.
Yeah, sure. One of the key things to remember about government spending is that every dime the government spends, every dime has to come from the private sector. They either tax it from the private sector or borrow it from the private sector. So when the government grows as a share of our economy, that means the private sector is a smaller share. And therefore there are fewer jobs created, fewer new inventions come along. And so when government shrinks as a share of GDP, which is the key point, we're not actually cutting spending, it's just growing slower than GDP today. What that means is the private sector grows faster, and we saw that today. Overall GDP was 2.5%, government was down, but the private sector grew 4%. So that's what we want to see. We want to see faster growth in the private sector, and as a result, I think the sequester in reality will help the economy grow at a more sustainable and a faster growth than just the plow horse growth if we continue to keep it in place.
Ryan Westbury, Chief Economist of First Trust Advisors, thanks for being with us. Have a great weekend.
Thank you, Tyler.
On Wall Street today, stocks were little changed. The modest rise in economic growth that we've been talking about, combined with a dip in consumer sentiment for April and a jumble of earnings, led to mixed results in the major averages. The Dow traded in the narrowest range in months, rising just 11 points. The Nasdaq was down 10. The S&P lost about 3 points. And all three indexes ended higher for the week.
One company that is keen on economic growth is McDonald's. The world's biggest hamburger chain keeps a close eye on hundreds of different economies, changing commodity prices and energy costs, and testing new menu items in its research kitchens. Carl Quintanilla takes us inside for the company's view of the outside.
There's probably no better company to talk to about the broad economy than McDonald's. 34,000 restaurants in 119 countries. They serve 69 million customers every day all around the world. A set of eyes and ears that practically are unseen anywhere else in corporate America. We're here at the Innovation Center at McDonald's, their basic giant test facility in suburban Chicago. And we talked to CEO Don Thompson about that GDP number this morning and what he sees for the broad economy.
We've seen kind of these starts and stops of a recovery. And I think retail sales earlier this year showed that things were slowing just a bit. Now, you have to look at it and take it with a bit of a grain of salt. We do see the impact possibly of a payroll tax. I think it's still a little bit early to tell. But also you've got, you still have a little bit of hesitance relative to certain investments back into the broader economy and relative to jobs.
The United States is an incredibly important market for McDonald's, 40% of their system-wide sales. And although Thompson sees a soft retail environment, they're trying to roll out some new products and drive traffic in kitchens like this one, things like egg whites for breakfast and a new pomegranate blueberry smoothie. For Nightly Business Report, I'm Carl Quintanilla, Romeoville, Illinois.
Well, McDonald's will be one of many companies holding its annual shareholders meeting over the next few weeks as proxy season gets into full swing. So what are some of the key issues shareholders are backing? Mary Thompson takes a look.
As shareholders descend on annual meetings, they're focusing on boards and pay. Add to the mix big shareholders lobbying for big changes. Chris Cernich of proxy advisor ISS Governance says the rise of activist investors makes for interesting meetings in the weeks ahead.
It's pretty lively. I personally cover contentious meetings, so contested mergers and proxy contests, and we're seeing that on a pretty steep upswing.
Among the meetings with big investors agitating for change, Hess's on May 16th. Elliott Management wants directors replaced and what it says is the energy firm's 17 years of underperformance. Timken's on May 7th features a proposal from the California pension fund CalSTRS aimed at improving value by splitting its steel and bearing businesses. While at Stillwater Mining's meeting on May 2nd, a slate of directors backed by the Clinton Group is up for election. Clinton wanting change given the palladium and platinum producers' loss of market value over the last 5 years. Other meetings to watch include Occidental Petroleum's. Under fire in the past for executive pay, shareholders now focus on directors. With the board launching a search to replace CEO Steve Chazen, supporters of Mr. Chazen may seek to unseat directors who don't back him. And in the wake of the London Whale trading loss, J.P. Morgan's CEO and Chairman Jamie Dimon faces a challenge to his chairmanship at the annual meeting on May 21st. The bank's board lobbying big shareholders to defeat that proposal. Meanwhile, unions remain focused on getting firms to change how and how much they pay executives. Here's the AFL-CIO's Vanita Anand.
Executive pay is an issue where companies should be most accountable to shareholders, but frequently are not.
So far this proxy season, shareholders at 5 firms, including Navistar, have voted against a company's compensation plan. These advisory votes assign to boards they need to change the way they pay top brass. For Nightly Business Report, I'm Mary Thompson.
And Tyler, as you know, one of the most popular and well-attended meetings is Berkshire Hathaway. This is Warren Buffett's company, and that's next Saturday.
And you will be there.
40,000 people as well who are going to be attending that. It's huge, and all coming to hear what the Oracle of Omaha has to say about
And generally,
a
they
lot
are
of
very
issues.
happy shareholders most of the time.
Yeah, the stock has been going up, up, up.
Have a great trip. Coming up, 4 stocks that this week's Market Monitor says you should own right now. But first, a look at how international markets fared today. We talked about it a lot on yesterday's program. Congress working toward a deal to end airport travel delays because of the sequester, those budget spending cuts. Late last night, the Senate approved a deal, and today the House followed suit, giving a green light to a plan which would ease the delays by allowing the Department of Transportation to use unused funds to pay for the air traffic controllers who had been furloughed. It is unclear, though, how quickly the furloughed workers will be back on the job full time. Shares of the major airlines were mostly higher on the day.
Also higher today, D.R. Horton, and that's where we begin today's market focus. Shares surged after the company reported second quarter earnings and revenue well above expectations. The nation's largest home builder earned 32 cents a share, easily beating the 19-cent estimates. Revenue came in just shy of $1.4 billion. The stock was up more than 8.5% to $26.66. Lower oil prices hit Chevron in its bottom line. The second largest U.S. oil company posted 4.5% drop in quarterly earnings and 16% in revenue. The company did earn nearly $6.2 billion in its first quarter. That works out to $3.18 a share, 10 cents higher than estimates on revenue of almost $57 billion. Shares, however, were higher on the day, closing at $120.04.
Well, the rubber met the road in the first quarter for Goodyear as the company recorded record profits in North America and Asia. Excluding special items, Goodyear earned 45 cents a share, rolling past Wall Street's target of 30 cents. But Europe put the brakes on things. Sales there fell 12% to $4.8 billion. Weakness in the European auto and currency devaluation in Venezuela were key factors, and shares fell on the news, down more than 3% to $12.51. Kellogg is hiking its quarterly dividend by 2 cents to 46 cents a share. That starts in the third quarter. Shares were essentially flat today, but are up a crispy 30% in the past year.
Our market monitor tonight expects the stock averages to continue their march higher this year. Diane Jaffe is Senior Portfolio Manager at TCW, and the dividend focus fund that she manages rose 21% last year. Welcome, Diane. I want to talk to you a little bit about your stock forecast because, you know, the economic growth numbers that we got today, not so great, and then earnings have been so-so. So why are stocks just keep going higher and getting close to new records?
The records are being broken, but the valuations are still unbelievably attractive. And, so that's a lot of important points for your viewers to focus in on is the valuations are still really exceptional and good opportunities.
So as you manage your funds, what's the key theme of the stocks that you're selecting?
They must meet one of our 5 valuation characteristics, generally speaking 3 or more, and they must have a company-specific catalyst to spur cash flows, operating margins, and eventually higher earnings growth.
All right, well, you have 4 stocks that you want to talk about. Let's begin with Pfizer, which is the largest holding in your funds. It's up 20% this year. Why do you like PFE that trades on the New York Stock Exchange?
For 2 reasons. First of all, they've gone through significant cost cutting and focusing on their core business of pharmaceuticals with the sales of the nutritional business, the sales of their, the spin out of 20% of their animal health business. And number 2 is they have a fabulous pipeline, which will propel future earnings.
All right, moving along. Tell us why you're recommending General Electric. It did report better than expected earnings last Friday, but its stock has been kind of stuck in this $20 range. What's the attraction here?
Well, you're right. The valuations are the same as they were 10 years ago, but there's a brand new company underneath. GE Capital is much less important to the day-to-day life of the company, and really they're focusing on energy and infrastructure and healthcare, 2 areas that we're very positive on.
And you think it's going to break out of that $20 range sometime this year or next year?
I think if they don't, Jeffrey Immelt is going to have to talking to.
Okay. Home Depot is the next one on your list. This is HD trading on the NYSE. Stock up more than 18%. What's the story here?
Well, they floated on the housing bubble and then came down with a crash. New CEO Frank Blake said we have to do things differently, and he continues to reinvest in the company. Right now, they're really focusing on technology and the distribution centers, and they're making it easier for do-it-yourselfers and the professionals to come in and buy products, the right products at the right price.
And the 4th stock that you're recommending, Citigroup, which is a somewhat controversial, as are a lot of the financial stocks. What's the, why do you like this one?
Well, new management, I think there's a breath of fresh air there. Remember last year, and they got their pay packages for Vikram, KO'd by the shareholder base. This year, they passed with flying colors. And so the turnaround of this company has gotten the approval stamp from regulators, and we think that there's more to go. Very attractive valuation.
And Michael Corbett is a new CEO. Is he getting your approval rating?
Thumbs up.
Thumbs up. Okay. Diane, any disclosures to make? Do you own any of these stocks?
I do personally own Citi, and all the other stocks are in our funds, including Citi.
Okay, fair enough. Thank you so much. Diane Jaffe, Senior Portfolio Manager at TCW.
And coming up, using social media to invest, why it could be a risky business. But first, a look at today's commodities, bonds, and currencies. Shares of Universal Health Services jumped more than 3.5% today. The hospital management company got a shot in the arm after 2 analysts raised their price targets for the stock. UHS also posted better than expected results late yesterday, and the shares are up a very healthy 30% year to date. Joining us now is Alan Miller, Chairman and CEO of Universal Health Services. Mr. Miller, welcome. Good to have you with us. You know, there are a lot of unknowns in the Affordable Care Act, but one of the factors that apparently is not an unknown is that there are going to be a lot more patients, customers for you who have insurance. How much is that going to help your business and affect your bottom line?
It's going to help our business tremendously. I think what you talked about, the analysts raising our expectations and our price targets, we're going to see 31 million people that have not had coverage before, and it's going to have a good effect on our bad debt. So that's going to go down. So that's going to be excellent. And one of the things that most people don't know is that there's going to be a lot of coverage going into the mental health area, because there is a parity law. If you have coverage of acute care, mental health must match it. And so a lot of the small plans haven't had that, and now they'll be obligated to have a mental health capacity, and that's going to be tremendous for us. Maybe another 31 million people will be covered as well. So we're very bullish about that.
Alan, talk to us a little bit about what patients, the consumers, can expect in this new world of healthcare with the landscape changing. One of the big questions always is about quality of care. Is it going to get better or is it going to go down? And what can we expect in terms of what we have to pay for medical care services?
Well, I think that one of the sort of misleading things when the plan was sold was that premiums would go down. I think premiums are going up. From everything we read, because of extended coverage, premiums are going to be going up. We are working very diligently to make sure that our quality is as high as it's ever been. And the government is helping that with some payments related to quality. So it's going to be more costly, but there's going to be no diminishment in quality at all. And we're going to have extensive coverage of the population. As I mentioned, about 60 million people, which is really a very good thing for them and certainly a very good thing for us.
What would be the one thing, Mr. Miller, that would do the most to retard the growth in healthcare spending in the United States?
Well, there's a complicated answer. It really comes around to the transition from just a number of volume procedures to some sort of a bundled payment where you'd have an organized coordination between doctors and providers. And that's what an ACO is intended to do. It would take a number of years to bring it about, but that's the only way I can see that you would get away from this continual escalation in costs.
Yeah, the thing that's always surprises me about healthcare is that in almost any other industry, you see prices coming down, whether it's a cell phone that's very expensive years ago and now it's so cheap. But in healthcare, no matter how much technology, no matter how much innovation, prices keep going up.
Yeah, but life is better. I mean, I think that's what the trade-off is. There was an article today in the New York Times about pharmacology helping to solve some of the problems with certain cancers. And we're getting a lot for the dollar, but it is going up. But people are living better lives and longer lives.
All right, Mr. Miller, thank you very much for being with us. We appreciate it.
You're welcome, Tyler.
Alan Miller, CEO of Universal Health Services.
And finally tonight, investors are always trying to find an edge. And in the 21st century, using social media is growing exponentially on Main Street and now on Wall Street. But when it comes to finance, Kayla Tausche tells us it's a risky business.
Social media has gone viral on Wall Street. Investors, traders, computers mining billions of pieces of information from Twitter, Facebook, StockTwits, and now Google, where new research suggests search history could hold clues to predict the market. But using that information is a viral game of risk, to be sure.
We got a big drop in sentiment last week.
In 2011, Paul Houghton, an English entrepreneur, and Johan Bolin, an Indiana University professor, claimed to have found a formula that would mine Twitter to predict the Dow. It was hailed as revolutionary.
Social media has enabled us to be able to take large sets of data from a large audience that we couldn't really do before. It needs a lot of refinement and it needs to be used in the right way. But it's certainly really, really interesting from our point of view. I mean, the results are astounding and we don't really understand quite why.
But not understanding why it worked was just too risky for investors. Their Twitter hedge fund closed just a month after it opened.
That the president is fine, I was just with him.
And this week's AP Twitter hack illustrates exactly why investors have a right to be cautious. For 4 minutes, markets went into freefall after false reports of explosions at the White House. 71 characters, a 150-point sell-off.
It's as much about trying to predict how the market's going to move off a certain story. And many times, independent of where that news item came from, people jump on board too quickly, whether it be to sell or to buy something in response. And many times it's the wrong move.
It's a delicate and dangerous balance for all investors between speed and greed. For Nightly Business Report, Kayla Tausche.
I think earlier this week that false tweet that went out is going to send a chill through all the companies that may have been trying to think about ways that they could use Twitter and Facebook to release information to the public, because one false move there can really disrupt
no
the stock.
shortcuts, Tyler.
No.
You know, you have to do real research, and there's
Absolutely.
no magic.
All right, everybody, that'll do it for this edition of Nightly Business Report. I'm Tyler Matheson. Thanks for watching.
And I'm Susie Garib. Have a great weekend, everyone. You too, Tyler.
We'll see.
And we'll both be back on Monday.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. Options Profits helps educate beginning and seasoned options traders. Action Alerts Plus is a charitable trust portfolio that provides trade-by-trade strategies. Online, mobile, social media. We are TheStreet.com.
I'm Susie Garib with a Nightly Business Report news brief. The U.S. economy grew by 2.5% in the first 3 months of this year, less than expected as businesses and the government spent less money. On Wall Street, that modest rise in economic growth combined with a dip in consumer sentiment for April and a jumble of earnings led to mixed results. The Dow rose 11 points, but the Nasdaq was down 10. The S&P lost about 3 points. A shot in the arm for J.C. Penney. It secured a multi-billion-dollar loan, allowing the struggling retailer to renovate more stores. Congress passed a bill that'll funnel money to the Federal Aviation Administration to bring those furloughed air traffic controllers back to work. And for the first time ever, more smartphones are being made than regular cell phones. Be sure to tune into Nightly Business Report right here on your public television station.